Excellent. So look, thank you everyone for joining. I'm going to chair today's discussion. My name is Chris Neely, and I'll introduce myself shortly. Just want to set a few ground rules. First of all, the session is going to take 60 minutes in total. Appreciate everybody for joining, taking time out of their busy schedule. This is a very large topic. We don't pretend that we're going to cover everything that's going on with IBOR transition or LIBOR transition on today's panel. Given the global nature of just who's on the phone, who's on the panel and on the webinar, there's many different things happening in many jurisdictions. We can and will cover things in greater detail on other webinars or indeed bilaterally if anybody has anything they want to cover. Where we want to attack this problem today is from a practitioner perspective. So PMC Treasury and indeed the panelists as well joining us are practitioners of what's happening here. We're on the ground, we're with clients, we're talking to banks, we're on committees, we're seeing what's happening. So we'd like to infuse this panel today with a practitioner bent so that you can really come away with it, from it, with an idea of what really needs to happen on the ground in the day-to-day over the coming weeks, months, and indeed year. There's a Q&A feature, so happy for anybody to ask questions. We're going to try to cover some of them at the end to the extent possible. So just ask away in the Q&A, and as things come up, and at the end we'll cover them. The session is being recorded, so anybody who wants to view it later, send it around to colleagues, or indeed anybody who wasn't able to make this panel will be able to view it later. If there's anything we don't cover or touch on, please feel free to reach out. I think most of you will have my information given the invite. But as well, at the end, we'll have our general PMC Treasury email. Happy to take any questions of any nature in the coming days. So our panel, we've done a few webinars through COVID, but haven't actually done a panel of this kind where we have a back and forth. I think it's safe to say that the happiest member of the panel is probably my suit jacket, which hasn't been out of the closet in 18 months. So we'll see how it does today. Chris Neely, I had risk management for PMC Treasury in the Americas, as well as our global technology. I'll be chairing. We have 3 other members of PMC Treasury here, so I'll try to take them in relative order. So Mark Beaumont, who heads risk management in Europe. Mark, give us a wave. Yeah, there's Mark. Tarek Imran, who's a senior member of the team on risk management in the Americas. Tarek. Yep. And then Jeff DiOrio, who's a managing director on our operational treasury division.
Hello, everybody.
Then we have 2 panelists joining us, which we're thrilled about. So thank you very much, just in advance. If they could introduce themselves. James, I'll pass it over to you to give an introduction.
Sure. My name is James Leather, and I am a former member of the UK's working group on sterling risk-free reference rates, having been on the cash market legacy transition task force. That task force was wrapped up a couple of months ago, but we focused on the active transition of legacy bonds and facilities with a good focus on the credit adjustment spread methodology. I'm currently Interim Deputy Treasurer for Landsec, the UK's largest commercial property developer and manager, and spearheading their LIBOR transition program across 2.5 billion of facilities, 2.5 billion of bonds, and about 500 million of derivatives, including systems and operations.
Great, thank you. Tom?
Yes, hello, everybody. I'm very glad to be with you. I'm, as was said, a practitioner. I'm a few decades, I don't care to admit how many, as a practicing treasurer, most recently 15 years as vice president and treasurer of FMC Corporation, a global chemical company based in the US. And I'm the chair of the US National Association of Corporate Treasurers and the immediate past chair and a board member of the International Group of Treasury Associations, which represents the national treasury groups in some 30 countries. And I'm the co-chair of the ARCs, non-financial corporates working group and a member, one of 30 or so voting members of the ARC, which, as you know, is managing the transition to SOFR, the new reference rate for the US. And it's very good to be with you. Thank you.
Great. Thank you very much. We just a moment on how the panel will go, the webinar will go. We have about circa five main topics we want to touch on, 5 slides. We're going to spend about 8 minutes on each of them, and that's going to leave time at the end of the 60 minutes for hopefully some Q&A. So hopefully we can answer some questions. The content on the slides are just meant for discussion, not necessarily reference material. Obviously, there's deeper reference material available, PMC Treasury and elsewhere, but the content is made mostly to facilitate the discussion. The central challenge for us here that we'd like to talk about is the operational disruption to your businesses as you go through the LIBOR transition, as well as the potential value transfer. Infusing here is going to be the concept of economic equivalence, as they speak of in the UK, as well as value transfer, which is a preferred term in the US. And we want the group to understand where is the potential value transfer? How is that manifesting itself through the transition? So operational disruption, value transfer are 2 things that we want to touch on over the course of the presentation. So with that, something is happening. Of course, everyone knows why we're here. But Tom, I think it might be good for you to just give a quick background as to how we got to this point. And then we can dive deeper into what's happening in the UK, which indeed is sort of at the front of the envelope. We'll talk about why that is, and then pass it over to the Americas as well. So Tom.
Great, thanks very much. Well, this actually goes back a while. Of course, LIBOR first started to be quoted in the 1980s, and yet in the 2008 financial crisis, there were some perceived breakdowns in the quotations, whether the rates were really representative or not, and there was an international recognition of a need to work on new reference rates. And IOSCO, the International Organization of Securities Associations, came out with recommendations post-financial crisis that said these rates that we rely on really need to have a significant volume of underlying transactions. And I was asked to join the first international effort under the Financial Stability Board's Market Participants Group in 2013 and 14, where we looked at what should be the new reference rates. And we reported out then in 2014 and urged each country to start its own effort for its currency. And the US convened the Alternative Reference Rates Committee in 2014, which in 2018 made a recommendation to go with SOFR, the secured overnight financing rate, based on a number of underlying treasury transactions that met those IOSCO recommendations. And I'll leave my colleagues to talk about the efforts in other countries, but Andrew Bailey famously started the clock ticking, and John Williams, the president and CEO of the Federal Reserve Bank of New York, has his countdown clock, which ends at year-end 2021, despite the fact that there's been some grace given for continued use of LIBOR for legacy transactions, which we'll describe in a minute. But it's been a long process.
Yeah, and it's interesting that this started a long time ago. It seems to be coming to a head now. James, why is it that the UK seems to be a little bit ahead of everywhere else in terms of the transition to SONIA? Why is it happening there prior to others at this moment in time?
Well, I think partly it's LIBOR under the microscope, so the London Interbank Offered Rate, and it was the FCA that came out and made the announcement to begin with back in 2017 that panel banks would no longer be required to contribute to the rate. So I think it's partly leading by example. Partly also they had identified SONIA as a replacement rate, and SONIA is relatively well established as a rate. It took a little bit of reforming, but SOFR, I believe, Tom, is a more recent is a more recent rate, whereas SONIA is more well established and used. And finally, the UK is a relatively small market, so the FCA can be relatively prescriptive, whereas the US is got, you know, all your states to get across the line, so it's a much bigger market. So I think the UK is leading from the front, has got a more well-established rate and a smaller market to deal with.
Yeah, and it's interesting from our client base that we obviously have a global client base, but because we're seeing this happen in the UK with Sonia earlier than elsewhere, it's a bit of a canary in the coal mine, if you will, about what's going to happen across the rest of the world. You know, indeed. So, Mark, what are you as in the actual client engagements on the Sonia transition? What are you seeing? What are the touch points?
Yeah, I mean, we're engaged right now in many client discussions in sterling, particularly, obviously, because it is at the forefront right now. Those discussions are across debt and derivatives, which I think is a key point. It's not our suggestion or recommendation that you attack one without the other. It is a package, and transitioning both at the same time, there are benefits in terms of potential mismatch and future cost leakage, and we'll come on to talk about that. So we are typically part of a team working in partnership with the client that looks to transition the combination of their debt and their derivative portfolio, their hedge portfolio. It's very situational in its nature. So, for example, dealing with a heavily syndicated bank debt package typically is via the agent, which can slow things down. And the agent makes no decisions, as you know. The lending agent, it's simply a post box, so therefore tends to slow things down. Typically, what we'll look to do is bring that process into an agreed heads of terms or a term sheets format, present that to the lending and stroke hedging banks, and then move on to document the agreed line items across both debt and derivatives. So that's a very basic description, practical description, if you like, of the type of work that's going on in sterling right now.
Are you seeing, we'll touch on the US or the Americas shortly with Tarek, but are you seeing banks initiate that discussion? Are you seeing, how is that discussion being initiated in the Americas and indeed elsewhere? It's been a bit of a stalemate, if you will. So how have you seen that discussion initiated in the UK?
Yeah, a good point. I mean, so yes is the answer. We've seen many bank communications, and I'm sure some people attending here have been the recipient of said communications, and we can drill down a bit later on the detail of what those represent. But within the package of that communication is an urgency and an imperative from the bank side, certainly in sterling, because they are under a degree of regulatory pressure to convert a certain percentage of their loan and derivative portfolios by certain milestones up to the deadline, and where we've I think made the most progress is actually where we've taken receipt of those communications, but we've actually, and acknowledged them politely, but we've actually proposed our own terms and our own term sheet, particularly in multiple bank situations. It's much easier to present a common set of terms that is consensus agreed from the home team, if you like, and present that to banks and work from that standard rather than entertain bilateral inbounds from banks in multiple bank situations.
Sure. And Tarek, as we move to the Americas, what contrasts that with what you're seeing in the Americas? I know, first of all, talk about what's happening, like when things are actually being discontinued in the Americas, in CAD and in the US, but also what are we seeing from clients and banks on the ground in engagements that we're working on?
Okay, to address those in order, what we're seeing in CAD, for example, is that as of May of this year, 6-month and 12-month CDOR has deemed to be no longer representative. So those two tenors have gone away. As it sits today, 1, 3, and 1, 2, and 3 month CDOR will continue to exist. There's no deadline to for those to go away. In the US, what we have is that as of the end of this year, 1 week and 2 month LIBOR will go away. 1 month, 2 month, 3 month, 6 month, and 12 month will continue. However, I highlight that they will continue only for legacy derivatives and loans through June 30th of 2023. For new loans, and this is a critical point that we see clients not really focusing on, is that for new loans and new derivatives, after December 31st of this year, the Fed certainly has prescribed that for loans, no new loans should be done in dollar LIBOR. So borrowers are going to have to prepare themselves. I think people thought, well, I get a reprieve now for 18 months. That's not necessarily the case, because for new loans and new derivatives, you've got 3 months to be in position. And what we're seeing in the US from clients is a lot of inbounds about how should I be thinking about this? What should I be doing now? We're working with clients to review fallback language, review existing documents, review pricing. As Chris, as you had mentioned, the US is behind the UK with respect to pricing. While many of the larger banks will say that they will provide pricing for term SOFR, average SOFR, the reality is that the only trades that derivatives-wise are getting done are daily compounded SOFR. This week, we may have noted in the press, there were 2 loan deals that were announced that are going to initially be priced at LIBOR, but they have a firm cutover as of December 31st to SOFR.
Right.
And those details we're going to need to take a look at much closer once those loan docs are available.
Sure, and it's an interesting point because I think, Mark, it's fair to say, just very briefly, the SONIA market from a markets perspective, a derivative perspective, is quite robust, whereas the SOFR market in the US isn't yet. The Fed is trying to push it in that direction, but I mean, Tarek, you were just pricing out some derivative transactions on SOFR recently, and it's difficult to get a price. So while you hear it from the PR side, on the ground, it's actually quite difficult to get a price. And how that changes between now and the beginning of the year is going to be quite interesting. It's a fluid situation.
Just to reinforce that, Chris, it's been impossible for many months now to draw down on a sterling LIBOR loan or transact a sterling LIBOR swap with banks, because as the cessation event draws near, it was mandatorily imposed within banks that they would not transact. So it becomes a given, a fait accompli.
Yeah.
Mark, sorry, is SONIA prevalent in derivatives at the moment?
Yeah, absolutely.
Yeah, it is. Yeah. So that probably is one of the reasons why the UK is at the front of the envelope. That liquidity in derivatives very much helps.
It was prevalent in the wholesale, has been prevalent in the wholesale market, interbank market for a long time, but it is now prevalent and exclusive in the OTC derivative market as well. In other words, doing a regular interest rate swap at a corporate level.
So I think that's a key thing, Chris.
So onto the change in the organization. This is going to have very large implications for everybody's business, and I think the number of stakeholders involved, the number of areas it's going to touch, I think is quite complex, and I don't think it's something that everybody is actually ready for. I mean, James, do you want to touch on what this means in a practical nature in an organization like you're trying to achieve where you are now?
Sure. Well, essentially, you need to grapple with where you're exposed and what you need to deal with, and so that means as early as possible making a plan. And the first step of that plan I have found to be helpful is the formation of a working group that is cross-functional and spans the breadth of the business and starts to engage senior people to talk about the issue of LIBOR expiring, to get it front of mind for them, and to then start identifying where the exposure lies, and to keep engaging with them in regular meetings to identify where the main exposures lie. And once you've identified that, you can then work out how you're going to deal with it. Are you going to leave it, or are you going to tackle it? And that then will unfurl with a plan with priorities and timings for each of the aspects. But you see it in your legal contracts, whether it's procurement, a sales contract, facility documents or bond documents. Your operations will be impacted. The accounting entries, and of course your systems as well. So you've got a wide range of things to deal with and people to engage.
Actually, Jeff and Tom, Jeff, if I could ask you, are people always aware that they're going to have an issue with the LIBOR transition, or is it lurking in places that people sometimes are unaware?
Yeah, thank you, Chris. I was going to reiterate what Tetrick had pointed out, that don't let those dates you saw on that prior slide lull you into complacency. We interview a lot of treasurers. We're talking hundreds, and some are very proactive and have teams, working, as James just mentioned, on the transition. But many have in a way underestimated the impact. And I think that's one of the reasons we were eager to do this panel. I think Tom can talk a little bit more about some of the different areas that James touched on, where there are impacts to you. Technology being one of them, and we'll speak more about that later. Tom?
Yeah, Jeff, thanks very much. So I mentioned earlier that there are some $200 trillion with a T of financial contracts that depend on LIBOR. However, that's the Fed's estimate based on looking at things like floating rate notes and loans and derivative transactions that ISDA reports. And that's actually a gross understatement of the exposure because, as James mentioned, there are any number of commercial contracts that businesses enter into that have adjustment clauses. If you have a long-term supply agreement, or you're buying a piece of capital equipment that takes 3 years for the equipment manufacturer to manufacture that piece of equipment, there are adjustment clauses where you make progress payments along the way. But if the supplier is late with the equipment, then there's an adjustment that's LIBOR based. All of these commercial contracts are out there. And yet I have to confess, as somebody who's been for many decades a corporate treasurer of a US-based multinational manufacturing company, that we don't always in corporate treasury know when the procurement people, took it on their own priority to throw this clause in there. And so I agree completely with the technique of for the corporate treasurer to organize a cross-functional team that consists of people from procurement, from sales service, from other staff departments like accounting and internal legal, and go through all the contracts and see where there's a way to amend those. Now, another category of transactions that's not in that $200 trillion number would be intercompany loans. As a treasurer of a US-based multinational, I administered some 30 or 40 intercompany loans to companies around the world. And for 10 years or more, there's been an international effort to make sure that us multinationals aren't using intercompany loans to take profits out of high tax jurisdictions and move them into low tax jurisdictions. So the OECD started this BEPS, anti-base erosion and profit shifting initiative. And so with intercompany loans, there's a high degree of scrutiny that exchange control authorities in countries that have those and central banks and tax authorities need to review your intercompany loans. And so corporate treasurers are going to need to start the process in time to get all of those approvals to reform their LIBOR-based intercompany loan structure to one that's going to have pricing that will survive these cutoff dates we've been talking about. So there's a lot to do, and I would, if you haven't gotten started now, you really need to start the sprint.
Can we just spend one quick minute before we go to the next slide? As anyone with small children will be acutely aware, what about the methodology of pretending the problem doesn't exist? Well, is that a solution here? What if you don't do anything?
Relying on fallbacks, Chris.
So what just touch on that for a minute, James.
Well, I mean, running the project for Landsec, I was quite tempted to do that. But then we found that the fallback clauses in the facilities and bond documents were inadequate, so it gave no clear solution. And yeah, if you just stick your head in the sand and pretend it's not happening, I think that there'll be some ugly surprises on the way. And so
ugly surprises in that regard could be quite economic, right? The fallback language could be quite punitive.
Well, unclear. So what do you do then for your bonds? So it could make them, dysfunctional. Therefore impact market liquidity in your bonds. Therefore impact the price of the bonds. You don't want that. You want the bonds and any financial instrument you have any contract you've entered into to still function in the way it is right now, and i.e. proactive replacement of the LIBOR rate in an orderly way. Because if you haven't, and you're still linked to LIBOR, and then you go beyond the cutoff date, you have something that is linked to LIBOR, but LIBOR doesn't exist, and therefore that instrument is non-functioning, with all the knock-on impacts.
And I think it's an interesting point on the financial implications. I mean, to transition into the real heart of the economic matter, so economic equivalence or value transfer, I want to dive deeper into what this means, what's going on with clients, what's happening with banks. I want to dive deeper into the issues with economic equivalence and value transfer. First of all, to start that discussion, Mark, can you touch on the difference between loans and derivatives, loans, bonds, and derivatives? What is the difference? Why are they not necessarily to be treated in the same way?
Yeah, so let's try and take a step back to go forward. So the overarching concepts of economic equivalence and/or no value transfer, which broadly are regulatory narrative for the same end objective, are just that. They are overarching objectives. At every link in the chain, though, in this very, very long and complex and huge chain, that is less easy to deliver. It is and remains an overarching aspiration as a global issue. Let me try and explain what I mean by that. So for example, and I'm not sure this answers directly your question, Chris, but it's a route to answer the question. There are many areas where cost could manifest itself for an end user of either a loan, a cash product, or a derivative, a hedge, through transition. The credit adjustment spread, first time we've used that term so far, and we're 30 minutes in, that's not bad, is just one of those. So what is the credit adjustment spread? It is, in derivative speak, it is a prescribed ISDA opined adjustment to the LIBOR reference rate to transition into the respective RFR, risk-free rate. In the case of sterling, that's SONIA, we know that. So in your interest rate hedge, for example, you are a single asset borrower, you have a piece of debt and you have an interest rate swap. You will be under transition, broadly speaking, from an economic perspective, you will be paying fixed on your interest rate swap and receiving floating. That LIBOR that you're receiving will turn to SONIA plus the CAS, plus the credit adjustment spread. That is predefined in the world of derivatives. It's locked in, and it was issued in March earlier this year. However, on the debt side, it is less clear what that credit adjustment spread should be. And I think that's the key of your question, Chris, which is, why is a derivative, which is a mark-to-market product, treated in the same way from a credit adjustment spread? Why should that be as a cash product alone, which is repayable at par? And that's also been part of our work. But if you think about that situation of that single borrower, single loan, single swap client of ours, if they are 100% hedged on their piece of debt to term, they are going to both receive that credit adjustment spread under the hedge, and they are going to pay it under their debt. That's been the primary proposal from most banks in sterling to date, is that the same credit adjustment spread that is used in the derivative world is used in the debt world. So broadly speaking, that borrower is indifferent. I am economically indifferent. I have been delivered economic equivalence because I'm receiving my credit adjustment spread and I'm paying my credit adjustment spread. However, for many, many borrowers, they are not hedged at all, or they're not hedged to term, or they're not fully hedged. So therefore, their outright cost of borrowing has risen. And is it arguable to state that economic equivalence has not been delivered to that individual? That's where that's been a lot of the thrust of our discussion with banks in sterling to date.
And Tarek, how's that manifesting itself in the US, in the Americas? Are you seeing a similar discussion yet happening around loans, derivatives? And James, just to tip you off for the next question, I want to talk about the difference between loans and bonds as well. So we'll touch on that after here. But Tarek, how are you seeing that manifest itself in the Americas in terms of loans, derivatives, credit adjustment spread, et cetera?
Yeah, I mean, I think similarly, there is no economic equivalence, i.e. there is a value transfer. If you were to go from LIBOR to SOFR using the CAS, or credit adjustment spread. And this is what is causing borrowers currently to kind of continue to sit on the sidelines. It's a question of, what should I be doing at this moment? For example, 3-month LIBOR at sitting at 12 basis points plus a 26 basis point credit adjustment spread, versus, 3-month LIBOR sitting at 12 basis points currently, and SOFR at 5 basis points plus the 26 basis point credit adjustment spread, gets you to 31 basis points. So that's a 19 basis point adverse economic impact that borrowers would incur on day one if you were to apply the derivative method to loans. So what we continue to see are borrowers look at this, want to understand their fallback language, which one of the main points that we strongly recommend our clients have is right to consent. We very much push back against what is referred to as the hardwire approach, where the bank can come to you and tell you this is market standard and this is what we're going to do. Borrowers really need to be out in front of this so that they do have some right of consent as to what their agent does on the loan.
Yeah, and just to bring this back, just to crystallize this, because this is really the central message when it comes to loans. So just for everybody listening on the call. So there is what's called this credit adjustment spread, which has been calculated on the back of a 5-year historical median average. So there was a methodology to calculate it. ISDA, who governs derivatives, has prescribed it for derivatives. Okay, park that. The loan side of it has not been prescribed. It is still, it's still quite fluid. And loans are a contract that can be broken, can be repaid at par. It is not a contractual obligation like a derivative to absolute term. And so there's what's currently happening, and it's a little bit more advanced with Mark's team in the UK, is that banks are saying we'd like to apply this credit adjustment spread to loans. But the view is that that may not deliver economic equivalence, and that may not have no value transfer. And so we and others are pushing back on that methodology with loans. And that is really the central message when it comes to economic equivalence. And we're further along in the UK. So Mark's team is further along with these discussions than we are in the Americas. But nonetheless, it is going to happen everywhere. And it is not if any bank comes and says, well, this is a fait accompli, it's been decided, it hasn't yet. So we encourage you to keep the dialogue open with your banks before deciding on how the loans will be treated through this transition.
Chris, it's Jeff. Can I interrupt?
Please.
So just to go back and touch on a point that both Mark and Tarek brought up, and it came up in the chat. So I want to encourage the people attending the webinar to use the chat, the QA function. We are looking at it. Tarek and I were speaking with the treasurer not last week, and the treasurer was in discussion with their bank. The bank had offered them both credit and the derivative to hedge that credit. And the fallback language on both of those components was different. And that's why you have to look at it, because they could have wound up in a situation where one of the pieces converted to SOFR and the other did not. And then we get into a whole discussion about, well, do you have hedge effectiveness? Are you going to get the proper accounting treatment for this? Or are things all of a sudden going to start moving to the income statement? And I know that's a US treatment, but internationally, there must be a very similar effect.
And James, can you touch briefly on the difference between loans and bonds? I know you're dealing with a number of bond issues, which may be slightly different than what's being dealt with on the loan side. Can you touch on the difference?
Sure. I mean, just to pick up first on a couple of things that were said just then, I think I'll come back to answer that question, but it depends on your position as an organization. So, do you have debt, and is it just standalone? So, you can deal with that. Or is it hedged? So if it's hedged, then you've got the issue of trying to transfer at the same rates. And that's where Mark's coming from. If you've got debt and you've hedged it with the same counterparty that you're borrowing from, if you're in that position, then you might be able to have the conversation with the same people at the same time. If you've got, the debt with a whole syndicate of lenders and it's hedged with a whole range of counterparties, then it could be more challenging. But anyway, coming back to loans and bonds, you've got the ability it's very helpful with in the UK, under UK legislation, the same I'm sure will be with the US, that you can negotiate with your lenders under facilities to the credit adjustment spread that you will apply to transition from LIBOR to the risk-free rate. And that's very helpful to be able to have a sensible discussion. In the UK with bonds, you can run a consent solicitation method to essentially go to a vote amongst your investors. And you can propose to them what you think is a sensible credit adjustment spread or whatever it is to apply. And then there will be a vote, and hopefully you can get it approved and it goes through. But I understand a key difference in the US is, yes, you can have a vote, but you have to have 100% agreement, which effectively means it wouldn't be a vote. And I think the US is going for a regulatory legislative solution rather than going for a market negotiated solution. Tom, is that right?
Yes, well, I participated in some of the first discussions with the state of New York, and as you all know, in our legal system, companies enter into a contract and adopt a venue, and typically for financing agreements, they adopt New York law. And so that amendment was introduced and passed in May of this year, April or May of this year, but it provides for a conversion mechanism if the contract never referenced anything that would happen if LIBOR were to go away. However, a standard provision in term loans and other arrangements is that if LIBOR ceases to be quoted, then the loan transitions to the higher of half of Fed funds or the prime rate, which is 3.25%, and that certainly is the rate to which it would transition. And so that's a very scary phenomenon. And so it's going to require some sort of a solicitation of an amendment that's more reasonable. I mean, in the term loan market, there are any number of institutional investors who trade the loan every day, and you don't know exactly whom you're dealing with until you engage in that kind of a solicitation. With banks in a bank group, presumably we've got some kind of a relationship for a revolving credit agreement that backs up the company's day-to-day operations, and can have, even if it's 20 banks in the syndicate, you can get them together and agree on it on another amendment. There's also federal legislation that will be along the same lines as New York State legislation. So it's still somewhat up in the air, I'm afraid.
I think, Tom, I think scary is a good word to enter our next slide.
Chris, can
Chris,
I,
another just to say on that loans against bonds situation, you know, in the UK at least, with loans you can have this behind closed doors negotiation with your lender. With bonds, it goes to a vote, and there's less scope for a negotiation. So sure. That's a key difference.
Good point. Jeff, do you want to pick up the scary formula that we're looking at? What is this?
So yeah, we've all been talking about what is the prevalent rate calculation that will be coming about, and so here's an example. And if you're a fixed income bond person, you're like, oh, that's trivial, but it certainly has a lot of pieces to it. Most of what we're hearing right now, and you've all been hearing that things are in transition, nothing's set in stone, but a majority of the negotiations we know that are going on just on your simple revolvers and that sort of funding mechanism are focused on compound look back. And that calculation is could become problematic for organizations, because they're talking about, look, if my technology can't accommodate it immediately, I'll do it in Excel. And yes, you can do it in Excel, but I can see Tom shaking there, because he knows that that when the auditors come in and others look at it, you have to validate what you think the payment was against what your counterparty thought the payment was. Anything could go wrong. You could get a rate wrong on a given day. You could instead of using spreading it across a 2 or a 3 day weekend and holiday combination, you could do that incorrectly, and so it could cause no end of issues. And so one of the things we've listed here is, you know, PMC has actually put a calculator out there for people to use, because the calculation is not trivial. There are components to it that may become confusing, and so we're hoping to at least give you some a resource that's no charge to validate your calculation and perhaps your counterparty's calculation.
The concept of calculation of interest is an interesting one, as is the valuation of derivatives. Everybody needs to value derivatives for the balance sheet, and given the changes in rates, LIBOR to risk-free rates, SOFR, SONIA, the actual valuation of derivatives is going to change as well. So, and some of them may be less than others, depending on how you're discounting it, but nonetheless, it is an impact. And I think you need the technology, your technology vendors need to have this in their systems. So whether it's a treasury management system. So Jeff, how do you know whether it's ready? How do you have a vendor prepare? How do you know whether they've prepared for the transition? How does that process work?
That's very good. And again, I'm clearly based in the U.S., but my thoughts here are global in nature. So as part of the ARC committee, we did a study on vendor preparedness, and frankly, some are prepared and some are not prepared, and you need to reach out to your vendor to understand if they are prepared. There is a paper on our website that will advise on this, so you can, if you want to get into more details. But at a high level, Chris touched on it. There's two fundamental calculations you have to be able to do. You have to be able to calculate interest and accrued interest, so you know that this is what the payment should be, or at least this is what I should be posting to accounting. And the second calculation is you have to be able to value your transaction. And if you can ask those two questions of your vendor and ask those two questions of pretty much everybody involved, can we calculate interest and can we value it on transactions, of course, that are on the books already or about to be on the books, that those are the two things you need to measure your technology against.
Right. And Tom, just
Chris, I can just add something there? Jeff, I think just having experienced directly talking to vendors and asking them if they're ready, I had the, I've had the interesting experience of getting a yes, we are ready, and that's great. So you put your borrowing into the system, into the test system, and test it out, and you can see a lump of interest calculated at the end of it, but it may not be transparent how that is calculated. So there's a further question to ask: is it visible? So the sheet that you're promoting here could be very useful to people, even with a sophisticated piece of technology, a treasury management system. It may not be transparent how it's calculating. So that sheet is still very helpful to people.
Good
Yeah,
point.
James, I'll mention that, obviously you've got a broad spectrum of end users. You've got some that are extremely sophisticated and can make this transition quite quickly and easily. And in fact, may even be set up today to handle that. And then you've got what I think is a much broader, as far as just sheer number of end users that just have no way to be able to understand this, calculate this, and further teach their staff. Oftentimes, particularly in the leveraged finance sector, you'll have a two-person treasury staff. And it's just not fair to push this down to kind of an operational type resource and ask them to understand this calculation and be able to perform this. So I think it's critical. One of the things I've heard, Tom, you mentioned this before, and I'm in full agreement that prior to term SOFR in the US coming out, there was no real solution to the transition of loans and new loans. So yes, this is the formula for derivatives. This is the formula if you want to do loans, although what I'm hearing for loans is that they most likely will not be compounded. It would be simple average, if not term. So yes, it's a very complex formula. And I think on the loan side, we have to simplify where that market goes.
Sure.
Well,
And I
Terry,
think-
thanks very much, but I do need to just clarify one thing in that our non-financial corporates working group recommended to the full ARC at year end, actually 2019, and in 2020, early in 2020, the ARC adopted our recommendation that average SOFR be used for intercompany loans. So if you go to the New York Fed website, as the O in SOFR would imply, it's an overnight rate, but the New York Fed has been publishing the 30, 90, and 180-day rolling averages of those overnight rates. And what we said in our recommendation that the ARC adopted is that, hey, if you need a forward-looking rate for your intercompany loans, right now what's available to you are one of these average SOFRs. So if you take, say, the 30-day average SOFR, you can reprice all your intercompany loans. You can use that, and the difference between that, because it's based on a 30-day backward-looking average, and one that would be like term SOFR that was had a forward-looking component, it's really very slight difference, and so that was the basis for our recommendation, and so you can get going. And now I'm glad to say that in August the ARC has linked up with the Chicago Mercantile Exchange, and we've got the CME rate that we've adopted as the ARC rate for term SOFR. So everything is in place now, and there are no more excuses for not moving ahead to make these changes.
So that's a good segue into what we should be doing. So as we mentioned, there's a lot of stakeholders involved. The most important thing is that there's broad buy-in internally in your organization for what needs to happen from now to the full transition. Our clients are on every step of this journey right now. Some haven't started, some are near the end. Doesn't matter where you are. We just need to keep moving to the right in this slide. So what I'd like to do is just spend 45 seconds on each of these very briefly to just touch on exactly what each of these mean, why they're in this order, and what we need to do to create the plan. So in terms of understanding and quantifying exposure, James, you're doing it real time. Do you want to just talk just very briefly about how one goes about quantifying what exposures you actually have in an organization?
Well, step one is identify the exposure. And then step two, and that's kind of where that working group came up, because those exposures are coming from different directions, and it helps to have that engagement. And over a few weeks, you can get the obvious stuff, but then it starts to crop up in less obvious places. And then step two, quantify what that exposure is. What is the impact on the organization if you don't transition or don't proactively, if you do nothing?
Yeah.
Answer that question. And that then starts to help you quantify the exposure in terms of not just, is it in 2.5 billion of debt facilities, but if we didn't transition, would there be an impact on the share price, for example, from the impact or the PR fallout, negative PR? There's two elements of quantifying the exposure. There is the actual value of the contract, but also there's the wider repercussions of doing nothing.
Right. And Mark, how does one go about reviewing fallback language in the documentation?
Yeah, it's a question I tried to answer from a Q&A as it popped up as we've been through this hour. But what the Sterling journey has taught us is that there are many areas to where costs can manifest itself. It's not all about the CAS. It's not all about the credit adjustment spread. There's making sure that post-transition hedges fully align to debt. There's ensuring that the fallback language on the debt, for example, is appropriate. And by that, I mean, and we're talking here that in the future, absence of SONIA. So you've replaced from LIBOR to SONIA. What if SONIA disappears? That's the fallback language that we're talking about in the debt. That it is an appropriately transparent central bank rate. And we don't refer to anything like cost of funds, because cost of funds is not transparent. It basically is whatever the bank says it would be. It's making sure that the ability to break the loan in future exists, and exists on a costless basis. And it also, cost can manifest itself as well in, we've had a direct experience of simply transitioning a hedge portfolio, forget debt for the time being, just simply transitioning underlying swaps where the net present value of the swap portfolio is intended to stay neutral and flat and not change through that transition. But we have had occasion where, let's just say, that hasn't been the case, and there's been some opportunistic sort of actions by hedge counterparties to try and increase their economics, shall we say. So right through the entire transition, there are many, many line items to be agreed and consented to between banks and borrowers and hedge counterparties and the banks. Any one of those could contain either current or future cost leakage. So that's the transition itself needs to be future-proofed against.
And Tom, we spoke about the economics relatively at length. What about the accounting, just briefly? How does one go about understanding the exposure, the accounting exposures as they transition?
Well, that's a key point for U.S. public companies who are obligated to file their financial statements quarterly, annually, and give updates whenever there's a significant event. And in the fall of 2019, the Securities and Exchange Commission in the U.S., with whom these filings are made, reminded everyone that you need to disclose risk factors as it relates to the transition from LIBOR to new risk-free rates. And so you've seen in prospectuses and in companies' annual reports all these disclosures. And I can tell you, having served on a disclosure review committee, which all public companies have to review these things, there's a lot of work that goes into it. So this first step in our staircase of quantifying the exposure, and it really that's required to be disclosed publicly, not just to your board and to internal management. And so you've got to have a rigorous process to do that. There are other challenges here, which would be, we've talked about the link between loans and derivatives. And of course, most non-financial corporates want to have hedge accounting treatment where they're not marking these to market every period. And so that can get out of sync if you don't pay attention to it.
Yeah, and I think, well, one thing to wrap up before we get to the very end is a board-approved plan. I think it's the best practice here is to make sure that everybody's bought in. There's a clear objective, first of all, and a clear way in which you're going to go about reaching that objective, and that it's approved by board, audit committee, subcommittee of the board, whomever, but that it is approved so that everybody has a playbook that they're working toward as they go through the transition.
Chris, not to belittle it, we have a vendor questionnaire that's available to everybody that's listening, that's on the website, that you can take and send to your vendors, because asking them, as James pointed out, asking the vendors of your technology solution if they're ready, you'll get the answer probably or yes, whereas being able to ask them 30 or 40 very pointed questions to give yourself some comfort, that's what it's there for. And I think the NACT will be distributing it, the ACT and the AFP are distributing it as well.
Excellent. So just to wrap up, we have 1 minute left. I want to say it is a very fluid discussion going on. So the transition is fluid. So stay close to PMC is on the ground, working with clients, talking to banks, working in the proper committees to understand what's happening. So stay close to us with questions in terms of what is going on, as we can help guide along the way. It's a broad topic. We could spend an hour on, each slide that we did, if not more. So any further investigation that you want or need, feel free to reach out. You have my info, and you have the contact for for PMC more generally to reach out, and we can get the answer back to you. And I guess the last thing, just appreciate everybody's time. Panel, thank you so much for the input, and everybody who joined, thank you so much for joining.
Thank you.
Total pleasure.
Thanks, Bill.
So we'll see you out there in the transition.
Goodbye, everyone.
See you the other side.
Bye.